Hello, everybody, Leisure Town Life. We're happy to be here today with the first of our series on TaxWealth. We have our guest host with us today, the CEO of TaxWealth, Bruce Jones, who will be leading this meeting and this presentation. We will have our next one January 4th. So as we normally do, we'll be recording this and putting it on our YouTube channel for Leisure Town Life, as well as the website for those of you who couldn't make it today. And I think you're going to find this very informative. We're going to try to keep it to 30-40 minutes. And then we invite you, if you have any questions, to either pop them into the chat area in Facebook, or you can, Bruce is going to be giving his contact information at the end of the presentation. So we invite you to connect with him directly. But he is a longtime associate of mine and a trusted resource for everything related to, taxes. Taxes, it's not a sexy subject at all, but somehow Bruce makes it that way. So we're really happy to have him here. So Bruce, I'm going to turn this over to you, and we welcome you.
Okay, well, thank you very much. Let me put this thing on screen here. I'm not very tech savvy, but we'll get there. Okay. All right, so thank you, Paul, and thank you folks for joining us and inviting me to share with you. What we're going to talk about today as the inaugural series of things that I'll be sharing with you folks over time on tax planning is what it is and how it fits into the overall financial planning process. Just very briefly about myself and my company. We'll start with myself. This is my 51st year in financial services. I started back in 1970. In late 73, I was invited to train under an international tax planner, which I did for quite a while, and I got cross-trained in financial strategy planning. So for 41 years, I was in financial planning industry as well, and which I retired from 8 years ago, but decided to stay in business and do what I really enjoy doing, and that's solving tax issues. So I founded my company, TaxWealth, 33 years ago in 1988, and what TaxWealth is, it's a tax analysis and solutions research company. So what we do when we identify the tax concerns, what the goals and objectives are of the client whom we're serving, their risk temperaments, all those issues, then we delve into law to find solutions. And we bring those solutions back to the table for review and understanding by the client and their CPA and their attorney. So we're very proactive in nature, but collaborative in nature as well, where we work with the client's own CPA and with their attorney. We're not here to replace anybody. We're here to work with them to identify the best possible solutions and to implement it appropriately. But at the end of the whole process, the final say as to whether something is going to be done or not is, of course, is with the client themselves. So it's very important that they're well educated, and that's something that I love doing. I love to educate. I love to teach, and it's important that that be done so that informed decisions can be made at the end of that process. So we've been around a bit. I've been around for quite a while, and we work with proven IRS tested strategies, nothing on the fringes, but things are very, very effective when they're found. It is interesting that how much is in tax law that folks are not aware of. And hopefully today you'll see or get at least a glimpse of some of the things that can be done to be of help. Now, this statement was actually put on the board of an adult education class on writing. And the teacher asked his students to simply punctuate correctly that statement. A woman without her man is nothing. Well, all the men said a woman without her man is nothing. Well, I have a hunch that there's probably quite a few of you out there that would take great exception to that. So the women, however, responded, a woman without her man is nothing. And what that leads us to is something very important. and that is the right perspective is everything, isn't it? And that's what we're going to talk about, is a right perspective as to generally what financial planning is, and more importantly, how tax planning fits into that process. So what is financial planning? Well, it's making the most effective and efficient use of only two things that any of us have. That's accumulated assets and discretionary income. Most people, I think, rely primarily on accumulated assets for their investment planning, for example, and they dismiss the discretionary income oftentimes. And the reason they do is they think, well, you know, I only have a few, maybe $100 left over after paying my monthly expenses. There's really nothing you can do with that. Well, they're absolutely wrong, because there's a lot that can be done with that, because there's a third ingredient to this, and that's called time. Take advantage of time value of money. For example, if I set up an account for one of my grandchildren, for example, and I just set aside $1 a day, and then that child takes over at age 20 and continues at $1 a day until they're 65. Well, they're setting aside $16,425 in total over that 65-year period. Well, or 40-year period, actually. But they couldn't retire on that. However, if you have an effective rate of yield over that time frame, for example, right now, this wouldn't be realistic, but at different times in our economies, it is or has been. And that, let's say they average a 14% yield over that time frame, they'd actually have over $1 million available to retire on based upon $1 a day. So time is very, very important. And also discretionary income, whatever that amount is, tied in with accumulated assets, is very, very important. So therefore, you're having a two-pronged approach in planning rather than a single one that most people rely upon. Now, accumulated assets can be cash, can be savings, investments, retirement funds, personal property, equity, and real estate. A whole plethora of different types of assets are used. Discretionary income is simply whatever you have left over after paying your monthly bills. But once again, whatever that amount is, it can be very, very effective over time. Now, there are 4 areas of financial planning: liquidity, tax planning, exposure to profit, estate planning. I'm going to drill down and really talk about tax planning, but I do want to touch upon the other 3. First one is liquidity. Now, what do we mean by liquidity? Well, it's getting your hands quickly on cash. And what would be the one overriding reason why one would want to get cash quickly? Well, of course, it's to offset an emergency. So we need to have an emergency fund. We simply do not know what's going to happen 5 minutes from now or 5 years from now. Some things adverse can come into our lives, and we need monies to offset that need, whatever it might be. Well, where do people put in, or how much should people put in for emergency funds? For a long time, it was pretty well accepted that there should be at least 6 months worth of expenses. I differ with that. I think it's whatever you need to put in these types of funds to sleep comfortably at night. And I have clients who have all sorts of different ideas about that. Some are very comfortable with 6 months. Others are comfortable with 90 days. Others won't be comfortable unless it's well over a year of expenses that they have readily available to tap into if they need it. So it really bottom lines into, what do you need to sleep comfortably at night with, that you can have access to immediately or very close to immediately. No loss of money is worth loss of sleep, folks. There's just too much of an impact that happens if you don't have a proper emergency fund. Now, where do people put their emergency dollars? Well, they put it in banks, savings and loans, credit unions, money market funds, a whole wide array of places that they can put it. But generally, in most situations, they are placed into what is called a fixed account. Now, a fixed account, let's say in a bank or a savings loan or credit union, is an account that you put your money in for a specific period of time, You know exactly when you can pull that money out and how much you have when you do pull it out. So to illustrate, let's say that you put in $10,000 into a fixed account in a bank. And it's a 1-year account. So you know that exactly 1 year later, you're going to march down to that bank and you're going to pull out the $10,000 plus the interest that you earned. And we're going to fudge in today's marketplace and say that you got a 4% interest rate. So you put in $10,000 a year earlier. A year later, you march down, you pull out your $10,000 plus $400 in interest. And now you have $10,400. You are ahead of the game. Well, not really. See, there's two things we have to look into and be aware of. The first one is that interest is taxable, isn't it? So if you're in a 30% state and federal tax bracket, which I think most people, if they're warm, alive, and breathing, can be in that tax bracket combined between state and federal. But now you've lost $120 in taxes. So you're really down to $10,280. Now you're ahead of the game. Well, not really. There's another tax we have to deal with. Now, this is not normally viewed as a tax, but anything that takes away from our dollars essentially is a tax, isn't it? And that's what inflation does. Inflation will deteriorate the value of those monies in terms of real value. Now, if we take just a 3% inflation rate, which is more than half of what it is currently, but at a 3% inflation rate, you lose another $312 of buying power of those dollars. And that leaves you with $9,968, less than what you actually put in a year before. That's your real value. That's what you really have to spend. So it's really important to always keep in mind the impact of taxes and inflation. If a person just focuses on fixed accounts in a bank, savings, loan, and credit union, and they follow that tack long enough, they are safely going broke. Safe accounts, but they are going broke. So keep in mind that there should be a net amount that you want to look at after the impact of taxes and inflation to see what you really are getting out of what you have in these types of accounts. So what I would suggest you consider is a multi-tiered emergency fund rather than relying just upon the bank, savings, loans, and credit unions. The bottom tier is the fixed accounts in a bank, savings, loan, and credit union, but they're taxable, as we just reviewed. But they also give the greatest access to cash. You can march down to your bank and get that money immediately, assuming the bank is open, of course. But you can get it, pull the money out, and you can offset whatever the need is. However, we also saw the impact of taxes and inflation on that. So you're going to get less value on a fixed account than you would have otherwise. So what I would suggest you consider doing is setting up a multi-tier system. You keep as minimum an amount that you're comfortable with in this first tier in the bank, savings, loans, and credit unions, and you put the bulk of your emergency funds into a second tier, which gives access to 7 to 30 days of those cash. Because whatever you have, if you run through your bottom tier, it still gives you plenty of money to get to the second tier and have access to those monies within 7 days to 30 days. But these can be tax advantaged. In my case, I use double tax-free municipal bond funds. I call my broker and that's what I get. I have a higher yield than I have in a bank, but there's no taxes to pay and I have access to those funds. I've needed actually calling the broker and asking them to forward the monies overnight. But definitely by law, I have them within 3 days. So it's just being more and more efficient. So you're still having the same amount of emergency funds you want, but it's being more efficient in how you use it and how you have access to it. And even more so, you might entertain having a third tier and that has to do with long-term care. So there's ways of being able to accommodate all of these within a multi-tiered system for emergency fund purposes, but gain a whole lot more value by approaching it in this manner than you would if you just stuck to a fixed account in the bank savings or in a credit union. Hopefully this makes sense for you. Now, exposure to profit, although I spent 41 years in that industry, I'm not going to delve into it other than to say that there are a variety of investment plan approaches out there. It could be real estate, it could be securities, it could be mutual funds, it could be managed accounts, it could be trust deeds, it could be a whole plethora of different types of investments that could be chosen. But they've got to be chosen based upon your goals and objectives and based upon your time horizons and your risk temperament. So keep those three things in mind whenever you're viewing or checking out whatever choices you are looking into for investment postures. Now, estate planning, a lot of people have wills. Question is having a will enough? And I would suggest that it isn't. And the reason that it isn't is because of the thing called probate, especially here in California. Now, California, as the example, does not have an estate tax, but it certainly has probate. And having a will actually thrusts you into probate. Probate is an absolutely unnecessary expense, but it can be very, very expensive. In California, I've been told by estate attorneys that a person is fortunate to be out of the probate process typically within a couple of years, sometimes longer. In my own case, I was finally finalized my father's estate. I was the successor trustee to my dad's estate. He died in 2012. Took quite a while before we were able to settle his estate. Now, fortunately, he had a thing called a living trust, an inter vivos trust. So in his case, it actually avoided probate. But still, there were a lot of elements to it and a lot of situations that were tied to it that caused the waiting period to occur before we could actually settle his estate. There's two basic types of trusts. One is called a testamentary trust, and the other is inter vivos, which means while living, or commonly referred to as a living trust. Testamentary trust thrusts you into probate because it's by testament or by will. So as I mentioned earlier, having a will automatically will put you into probate. So does a testamentary trust. There are reasons for testamentary trusts, but largely I would suggest that you talk to a qualified estate planning attorney, look at all the advantages and disadvantages of both types of trusts. I think he'll probably favor the inter vivos or the living trust, but don't just settle with a trust. Get an entire trust package that would include what is called a living will, which deals with what happens if a person becomes incapacitated, who's going to pull the plug, for example, or a pour-over will. A pour-over will is a catch-all instrument that if there is any asset that is not in the trust at death, then that will go through probate, but that will show that to the probate judge that it should have been in the trust all along. He will pour it into the trust, and the trust instrument will take over at that point. So it becomes a mini probate process rather than a very lengthy one. But talk to a qualified estate attorney. And I would also suggest that because of changing laws that we're certainly seeing even now, you want to review your trust probably every couple of years, just to be on the safe side. Now, let's drill down and let's look at tax planning. But first of all, I would ask you a question. Do you have a mission statement? It's really, everybody should have a mission statement. But my question to you is, have you ever seen the IRS's mission statement? And this is off of their website. Their mission statement is the IRS mission is to provide America's taxpayers top quality service by helping them understand and meet their tax responsibilities and by applying the tax law with integrity and fairness to all. How are they doing? Well, if President Biden gets his way, he's going to have 85,000 more IRS agents knocking on our doors. I think part of their mission statement isn't being fulfilled as it should be. Now, what's the government's attitude toward taxes? This was a statement that was once given by a senator. It says the art of taxation consists in so plucking the goose as to obtain the largest amount of feathers with the least amount of hissing. Who do you think said that? Would it be Chuck Grassley or maybe Leahy? No. The person who said that was actually J.B. Colbert, who was the French Minister of Finance for Louis XIV in the 1600s. And the point being that government's attitude toward taxes doesn't change. Doesn't matter the country, doesn't matter the era. It's the same. They're after the taxes. So what is tax planning? What is all that about? Well, when you really boil it down, folks, they're very expensive. We know that. We're all aware of April the 15th, the day that we have to file the returns and pay the taxes. But are you aware as to the impact of April the 16th? April the 16th is called Tax Freedom Day. And that's representative of the length of time for all Americans as a whole, where they have to work in order to earn the monies to pay all the taxes that they have to pay. So from January 1st to the 16th of April, that's 105 days that we're in indentured servitude to the government. Because that's how long on average it takes us to earn the monies to pay the taxes that we have to pay. So yeah, they can be expensive. They're not going to go away either. And also they are always going to change. We're certainly seeing that today with the proposed changes that President Biden wants to do. Fortunately, what he has proposed, the House Ways and Means Committee has shaved down quite a bit, and it doesn't appear as though even they got everything that they wanted with the changing tax laws that are going to take effect. But always keep in mind that they are expensive, they are not going to go away, and they are always going to change. So consequently, you always have to be aware of changing law and update where you are at any given time as those laws change. Now, how I view tax planning very practically is through an acronym of debt. So as I'm paying my taxes every year, I'm reducing my debt to the government. So it's a very easy acronym to follow. The D stands for deferral. Now, deferring taxes means that you're taking the tax problem today, you're thrusting it out in the future, knowing that someday you're going to confront it and you're going to pay the taxes. Examples of that is a 1031 exchange and investment real estate. You buy another property of equal or greater value and you get to defer all the taxes into the new property. IRAs, 401ks, 403bs in the schools and the nonprofit worlds are all examples of deferral. Again, you're just deferring the inevitable. Now, some people think that you're going to be in a lower tax bracket at that time. That may be. I think it's unlikely. They forget, for example, that children grow up, and as they leave the nest at home, then the parents lose the tax deductions, and their tax rates oftentimes increase automatically because of that. So even in the later years of life, those tax rates can be a lot higher than perhaps they were earlier in life. So deferral is the first approach practically in tax planning. Second one is we want to eliminate taxes. Is that possible? Absolutely, it's possible. There's a thing called tax credits. Now, if you don't understand the difference between a tax credit and a tax deduction, allow me to share it with you. Let's take tax deduction first. That's like an IRA or 401k. Let's say that you contribute $10,000 into a 401k. That's going to lower the threshold of your taxable amount of income by $10,000. So to find out how much you save in actual taxes, let's say that you're in a 30% combined state and federal tax bracket. So you multiply the $10,000 of deduction by the 30% tax bracket, which means you save $3,000 in taxes. That's a deduction. A tax credit is an entirely different animal, folks. A tax credit comes dollar for dollar off your bottom line tax. So if, for example, you have $10,000 of tax credits and you're in a 30% tax bracket, how much do you save? You save the $10,000, which is more than 3 times the amount of tax savings than you can ever have through a tax deduction. You can never beat a tax credit when it comes to mitigating income taxes. It's king. Don't dismiss the deductions, of course, but if there's any way of being able to identify and implement tax credits, you want to do it. The $250,000, $500,000 exclusion on the sale of personal residences is another way of eliminating taxes. The rule on that is that if you've lived in the property for 2 of the previous 5 years prior to sale, you get to apply that tax-free amount. Now, interestingly, both spouses do not have to be on title. Only one of the spouses needs to be on title, but both spouses need to have lived in the property for 2 of the previous 5 years prior to sale to capture that benefit. Charitable tax planning. Now, I've got a 50-year history in charitable tax planning. I'm somewhat familiar with it, and I can tell you that given the right circumstances, given the right goals and objectives to be met, charitable tax planning can be extremely, extremely valuable. We can use charitable tax planning, for example, to eliminate capital gains taxes on the sale of properties or businesses. We can use charitable tax planning to generate a tax deduction to help offset income taxes. There's a whole different type or array of ways of being able to do that in the tax planning, charitable tax planning world. But given the right circumstances, it can be extremely, extremely effective. Now, becomes is the third practical approach to tax planning. One thing becomes something else. And the real word I'm looking for there is actually conversion. I used the B because I didn't want to mess up my acronym, but what that means is you're taking something and you're converting it into something else. And a really, really good example of that came to us 35 years ago in law. And this is a way, and a surprising way to many, of finding new money. And this came into existence with the 1986 Tax Reform Act and under President Reagan. And it's known as cost segregation. And what cost segregation does for those of you who might own investment real estate, that's improved real estate like single family rentals, apartment buildings, commercial buildings, industrial buildings, all of those. What it does, it allows you to segregate out or partition out certain components that are tied to the property and literally change its character from real property that has either a 27.5-year straight line depreciation or a 39-year depreciation schedule if it's commercial property, and change those components to personal property and accelerate that depreciation on those components to 5, 7, or 15 years. And what that does, it either gives you more tax benefit that you can apply against taxable gain on what you want to sell, or it gives you an instant increase of cash flow completely tax-free. Let me give you an example. This gentleman bought a $10 million office building 10 years earlier, 39-year normal schedule and straight line depreciation. Over that 10-year period, he rightly took a little more than $2.5 million of depreciation benefit. Cost segregation allowed him to accelerate $1,358,970 in the first year of doing this. He was in a 35% tax bracket, and that gave him an instant increase of cash flow of $475,640, completely tax-free. And he can turn around and use those monies any way he chooses. In this case, he bought more real estate with it. So it's a great way of leveraging, using tax savings to buy more properties or other investments, or pay for a wedding, or do renovations of a house, whatever you want to do, totally up to you, under your total control. What types of properties is this applicable for? Well, a whole wide array of properties. Here are just a sampling of the types of properties that are available, from apartments and single family rentals, medical facilities, mobile home parks, new construction. Also, if you've inherited properties, when you inherit the property, you get a brand new cost basis for that property. If, for example, the property was originally purchased by the decedent for $100,000 and now it's worth $1 million and you inherited it, your basis becomes $1 million. So now you have a brand new depreciation schedule based upon $1 million and not the original purchase price by the decedent. So cost segregation is a very, very powerful tool. As I said, it's been around for 35 years. I would dare say that most investment property owners have no idea it exists. Now, let me give you a really good example of that. I got a call earlier this year from a doctor in Chicago. He found me on the internet. A very interesting gentleman. He had 13 children. All of them are in medicine except for one, who's a San Francisco police officer. And one of his daughters, who's a physician, had her practice in a building that her father owned. And she wanted to buy the building from her dad. Her father absolutely wanted to sell the building to his daughter, but he checked with the CPAs and they informed him that if he did that, he's going to have a $124,000 tax problem, state and federal, on capital gains. Well, he wanted to sell the building to the daughter, but he certainly didn't want to pay those capital gains taxes. So we talked about different planning approaches, and we struck on one that would defer the taxes for quite a while, decades actually, and give him tax-free monies at close of escrow after selling the property to his daughter. However, I asked him the question, Doctor, do you own other real estate? And I thought that was probably a pretty sure bet because most doctors own real estate. And he did. He had a whole portfolio. So I said, well, tell me about them. Well, the very first property he told me about, he had bought 3 years earlier. I said, how much did you pay for it? He says, $4 million. Any improvements that you've made to the property? A couple $100,000. And I stopped her and I said, Doctor, you don't have a tax problem. What do you mean I don't have a tax problem? My CPA said I'm going to pay $124,000 of taxes. I said, so I told him about cost segregation. And I said, you don't have a tax problem. You have at least $400,000 of tax benefit available to you right now in that property that you already own that can be applied against the taxable gain on the property you want to sell your daughter. You don't have a tax problem. Well, he got me the information I needed to have my experts run the numbers, and that one I was spot right on. He had just over $400,000 of tax deduction available to him. He sold the property to his daughter and didn't pay a dime of taxes. He had the solution in hand and never knew it. Now, interestingly, when he first brought this up to his CPAs, they told him it was a scam. They had been in business. It was a husband and wife CPA team, had been in business for over 20 years. They had never heard about this. They were sure it was a scam. Well, the what is commonly referred to as the Bible for the accountancy world is called the Journal of Accountancy. So when the doctor told me that and what their attitude was, I went to the Journal of Accountancy and there was an article there on cost segregation, basically begging the CPAs of the world to do this. So that was sent to them and they still had reservations, and in their case, they no longer became the client CPA. He fired them and got hold of somebody who understood this plan approach and applied it. But this has been around a very, very long time, folks. It's a phenomenal tool. And it's also the best investment anybody can make in this country. Not just cost segregation, but in general tax planning is. Tax planning, if you view it as an investment, is absolutely, hands down, the best investment anybody can make. Let me prove that out. And let's take the doctor as the example. The IRS is very aware of this planning approach. And they really don't have a problem with it, but they do ask and require that the person doing this have a formal study done on the property they want to do, of multiple properties, by a third-party expert in cost segregation to do a formal study and prove out the benefits based upon the IRS regulations. Well, there's a cost to that. And for that doctor, that cost or investment was $15,000. So he invested $15,000 to doing this tax planning tool. The return or ROI on that investment would be the tax savings. Well, the tax savings was $124,000. So the question is, what is his real ROI or return on investment for that $15,000 investment that he made? Well, first of all, it needs to be understood that that $15,000 was deductible. So after taking the tax savings on that deduction, his net cost or investment was $8,750 total to get $124,000 in tax savings. Folks, that's better than a 14-to-1 return on his investment in 60 days with no risk. You cannot beat proper tax planning if you view it as an investment. Another thing that comes out of that, of course, is that you have more money through the tax savings to turn around and invest however you choose. So you have the time value of money aspect on that as a benefit as well. So something to keep in mind. So we talked about deferral, we talked about elimination, talked about becomes or conversion. The last one is transfer. There are ways of taking taxable amount of incomes from a high tax bracket and transfer them to somebody in a lower tax bracket and still control the whole amount of cash. A good example of that is hiring children. You can hire your kids. You can set up, for example, if you have investment properties, you set up a family management company and lease out your children and write off that expense. So they do the maintenance on the properties or whatever it is you have them do legitimately, but you're paying the kids for that amount of time spent, but it becomes a tax deduction. Most every parent in our country, or anywhere for that matter, when they supplement a child's expenses for whatever it is, sports, education, whatever it might be, it's almost always with after-tax dollars. So oftentimes you have to earn a $1.30 or $1.50 to pay $1 in supplementation to those kids on whatever you're paying for. Well, there are ways of being able to write those off and pay those expenses with pre-tax dollars rather than after-tax dollars, being much more efficient. And hiring children in the right way is one way of doing that. Now, let me give you some actual examples, then I'll close out for our session today. This was a printer actually in Anaheim here in Southern California. And his situation was that he had a personal income from his business of $207,690. He's paying over $151,000 of taxes, or taxable income rather, and paying over $30,000 in income taxes. By reviewing his tax returns, we identified tax credits of $33,400 that his CPA was not aware of. So we were able, just from that alone, to completely eliminate his income taxes, give him added tax savings, and we found another $58,000 of tax deductions. So as a result of all of that, we were actually able to wipe out his taxes and increase his income each year by $25,000 a year, and all of it completely tax-free. This was a dental practice that was sold up in Northern California about 3 years ago for $1 million. We used a deferral technique on this. Was able to defer the taxes for actually 3 decades. And instead of him receiving after-tax profit of $502,650, he actually ended up with $683,934, all completely tax-free, and he has since turned around and invested as he chose to. This is also an example of taking advantage of time value of money, because instead of paying the $232,400 in taxes for the year of sale, he only had to set aside 28,866 at a very modest yield as an average over that deferral period. And that would grow to meet the tax burden when the taxes were due to be paid decades later. But he increased his net by 40% as a result. This apartment building was sold for $10.2 million. Their taxes were $1.9 million plus. They would have netted out a little more than $5.7 million on a conventional sale without doing proper tax planning. However, by doing proper tax planning, they ended up with just over $7.4 million, all of it tax-free. So they increased their net by 30% or $1.7 million more than they would have otherwise in after-tax profit had they not done this. So I'll leave you with this, and always keep this in mind. Next to being shot at and missed, nothing is really quite as satisfying as an income tax refund. I hope you found what I've shared with you of value. This is how you can contact me. If you have any questions, you're more than welcome to email me or call me. And we're here to help you. We're here to serve you. There's no cost for a consultation. So if you find that you have a need, please reach out to me and we'd be more than happy to be of service to you. Thank you very much.
Thank you, Bruce, and thank you, community, for joining us. Again, we look forward to having Bruce back on January 4th. And thank you again, Bruce. Very informative. Have a nice afternoon.